you're not really using your secondary property or potentially Airbnb-ing it, I think there might be an opportunity to get out while the market for those is still very hot. Everybody was buying secondary properties because they're getting cash out of their homes and money was cheap. But now there's going to be a drop off on that. I would make a shift on that quickly if I'm going to do it or try it. Additionally, I've been chatting with people who Airbnb a lot of their secondary properties, and they said booking volume is way down.
Interesting.
Like 50% down. So I think that's kind of an indication of people just don't have as much cash to be spending.
Also, we're comparing it to recent years where it's like, well, there's COVID, so you can't go down south. And everyone has a lot of money. So like it was a perfect storm for the short-term rental game. If I were to take a contrarian point of view to that, it would be if there are leaner times ahead and you have a good position in your primary residence, i.e., you know, you've got a low rate that's fixed in, it might be just a chance to be thankful for the position you're in and just enjoy that and take a pause. So I'd be wary of 100%. Selling something that's in a good position, even if it's like trying to be opportunistic or worried that, oh my gosh, you know, maybe I'm at the peak now. I might give back, you know, $50,000 over the next 18 months. It's like, sure, but if the alternative is you change your living position and it's less advantageous, then it might not make sense.
When I was broke, I had rich habits. When I was broke, I had rich habits.
Oh, looking good, looking snazzy there, buddy. Cool racing hat there, bud.
Yeah, you know why I wore the racing hat?
Because you were just at the... Were you at the F1 in Montreal?
I went to the F1 in Montreal. I didn't actually go to the race. I just went to qualifying.
I was going to say, I didn't see you in the... Yeah. Max Verstappen? Did I say that right?
Yeah.
Who cares?
Yeah. But, man, couple things. Like, first of all, if you haven't been and you're an F1 fan, like, you got to go. It's crazy. Like, in Montreal, you have to all come across this like bridge to get on the island where the track is. Yeah. And just as you're like coming up, there's like a straight stretch of a track right that abuts the main entrance, and so there's just like, boom, like I don't know how to explain how fast they're. Like it's not like it's like going by. It's like,
yeah, that's
like you
crazy.
You can't even begin to see them. Like it's craziness.
This is actually
like
we should do
on the grounds.
We should do a plug here. What's the BNV show? F1 Casuals. Yeah, there's another podcast here if you guys are in F1. Really, but
yeah, true. Boys are on there.
Yeah, I remember like they had some sort of race here in Halifax years and years ago when I was a little kid. And it was kind of cool because they ripped down by like the willow tree in the Commons. And I remember I was on like Citadel Hill or the Wanderers. I can't remember where I was as a little kid watching it. But we were at like a turn where it was kind of slow or whatever. My dad was in a pit crew once too.
That's neat. That was super cool. Anyways, it was unbelievable pulling up. I don't actually really follow it that much. But the other thing that was a little crazy is so we went to qualifying. It's piss pouring rain. So you're just sitting there in your ponchos. Everyone's sitting there in their ponchos and it's just downpouring. But the crazy part to me was if you guys have been to Montreal, the whole track is like 100,000 people funnel out through like one exit. And then they have to get onto a subway line. Like everybody gets onto the same subway line.
Sounds terrible.
So you literally spend like 2 hours just grinding your way through the mud up to this hot, steamy subway line, and then they just jam you in. Like I don't know how that they haven't come up with a better solution for that yet. But other than that, it was amazing. I recommend it now. I want to go to a bunch of races. Like it's just it's a cool experience.
I think one of our colleagues, she went to the Monaco Grand Prix, I think. Madison.
Oh, it's badass.
Yeah.
That's badass.
Yeah, super cool. Yeah, I mean, this is the Master Keys podcast. Chandler, Neal, thanks as always for listening, guys. We talk about real estate, wealth creation, all the cool stuff, anything that's going on in the world that we think is relevant to what may be going on in your world. So appreciate your support. If you get anything of value. Yeah, cool guy with his race hat there.
Yeah.
Listen, I have a question for you. Speaking of Montreal, someone on my Instagram just did, the big public announcement. I'm leaving this town. And one of the reasons cited was affordability and going to Montreal because, Montreal's way more affordable. It got me thinking because we talked about this and people have asked me, like, what's going to slow down the rental rates? Like, what's going to slow down pricing? And I've theorized, well, if we have this mass exodus like we had in, say, the early 2000s, where all the young people were leaving Halifax, Nova Scotia, and going elsewhere for job opportunities, if we have that again, that would be the sort of thing that could really jam our market, like slow it right down and curb rental increases. Have you seen people starting to leave the province again by any chance? Or is it still early for that?
No, I very much have seen people leave the province.
Already? Okay. Interesting.
Like we talked about this before, I think a little bit, but there was a huge population that moved here from the other provinces, predominantly Ontario, because Toronto was probably the worst hit by COVID, which makes sense due to the density. But a ton of people are like, I'm done with this shit. Like, I don't want to be locked down in my apartment or my condo or in a city that doesn't care and all those things. So a ton of people came out here and they're like, I'm work from home, so I'm work from home forever, so I'm good to go. And then a lot of companies turned that back. And I think a lot of people started to see there's a mixture of like people came out and like, whoa, this is a much different lifestyle than I expected. I fantasized about this, or I enjoyed it in the summer times, but I don't want to live here. And then there was jobs that were like, yeah, we now need you back in the office. Or a lot of people are cost cutting right now. And where are they going to start cost cutting? Are they going to look at the people that are still in Toronto coming to the office every day? Or are they going to look at Joe who moved to Halifax and chilled on a boat all day as their first cut, right? So I think a lot of people started kind of panicking and moving back. And so I think you do see that. And then we talked about how Alberta's running aggressive ad campaigns. The oil and gas industry is doing well. So you're seeing people move to Alberta simply, again, just on an affordability basis because it's more affordable there to live, lower taxes and income. There's also a ton of people that are doing the 2 weeks on, 2 weeks off. But I think more and more people are now being like, well, the average house price in Atlantic Canada is almost the same as Alberta.
Yep.
So why am I doing this back and forth?
And rent's higher. Rent's definitely higher.
Rent's higher. I can just move my ship over here and not have to worry about that. So yeah, I think is a huge change in direction.
I had another one
showing the stats yet.
Yeah, I had another one who's an investor from Ontario, young guy, came out here, was doing some small scale development stuff, doing some development flip plays and all of these things, and I can tell he's now like, you know what, I'm getting rid of my stuff here. I'm going back to Ontario because it's bullshit out here. Everything's so expensive. It's so expensive to do anything, and yet then when it comes time to the rubber to hit the road, there's maybe not as much money actually around at the same time. And he's very frustrated by the opportunities here or lack thereof. And as a young person who's not connected or committed to this area, he's just going to turn right back around and leave. He's just kind of tying up loose ends here. So it's interesting to see that. And when you mentioned Montreal and I thought about this person on my feed and all that, I was curious to see if you'd seen that. But that's not what we're talking about today. What are we going to dive into today?
No, today we want to talk about what we think you should be buying, what you should be holding, and what you should be selling. And kind of just based on what we're seeing in the market, what's going on. And I think a lot of people, I would like to think a lot of you guys are going to be interested in this because it's such a weird time. And again, it's one thing to be a home buyer. It's another thing to be an investor where you're trying to make your money be active. And I know for myself, whenever I have a refi come in or I have cash, whatever it may be, I'm like dying. I'm like, I have to have something under contract. I have to be closing.
Yeah.
Like I couldn't fathom having just like excess cash in my account. I must spend this on something so that I'm in an uncomfortable position again of having no money where I need to keep working. And so I have a couple here written down. Maybe I'll throw things at you and kind of get your take on what you think. Where do you want to start? Buy, hold, or sell?
Start with buy, our favorite.
Okay. We're going to start with what to buy because I think that's also probably one of the hardest ones to make a guesstimate on right now, simply because where the hell is the market going? I'm going to give you everything that I have and what my thought was, and then maybe we'll get you to break them down one by one. But first, I said buy development land. And the reason I say buy development land for two main reasons. I think that there are a lot of opportunities coming to play because even you see large companies, big developers,
unloading,
they're selling off parcels that they don't necessarily see being built for an extended period of time. And because they need cash, because a ton of people are in projects right now and where rates have run, they're like, oh shit, the bank's like, you need to come up with $2 million, $5 million to finish this project. And so they can't always just be taking these massive hits on their book and they don't necessarily always have that cash available. And so development land, you'll start to see, I think, a lot more of it being listed. And I think there will be opportunities available. Additionally, I've talked about this in other pods and listening to everything that's going on. I do think in the years to come, there's going to be incentives around construction. There's going to have to be, in my opinion, which I think ultimately will then push up the land values.
Yeah.
And like for hyperlocal to Atlantic Canada, as we're at this like weird turning point where condos are starting to become relevant. And I think if that can sustain, it'll really drive land values up because the condo market can push up the per door value immensely at the very end of the build. And then really, if the per door value goes from 500 to 800, of that 300, probably 60 or 70% of that will get boiled into the land. And you see that in Ontario and BC land pricing. So number one, I said buy development land. Again, assuming it's a good deal. It doesn't mean just buy everything willy-nilly. It's got to be the right deal. It's got to make sense, and it has to be financially sound for you. And when you're buying land, you need to understand that you can't get the leverage on it that you're probably expecting. Max 50% with a plan to build. And additionally, you got to be able to cash flow it. There is going to be costs associated with vacant land insurance, property taxes, and if you're taking cash from something else, like it's something you have to consider. The second one is commercial real estate, and I say that as a whole kind of blanket because there are portions that I don't necessarily think are worth buying. Like obviously, everyone's hearing about office and retail being a bad place to invest, but I do think there are. The way to look at it, in my opinion, is you look at the commercial industries that are poised to do well, even when the economy is slowed, and try and invest in commercial properties that are leased to those companies where they will be able to sustain through this entire wave. And that means like you have things that are anchored by drugstores, insurance companies, like those the businesses that ultimately end up doing well during these periods. Those are the investments that you want to make in the commercial world. Additionally, this is something that's always done well in the past, but I'm not as sold simply because it has done well in the past and feels like everybody's leaning this way. Is storage.
Yeah.
I think you need to analyze the market. I do think storage seems to be a really great play. It runs at high caps, low loan to value. So if you can get into it, usually you're not extremely exposed. And on average, when people are downsizing from homes or there's a lot of movement going around, storage lockers tend to become a lot more relevant. I just have some nervousness where 2008 storage did super well. And so now literally every single person seems to be starting some sort of storage business. You see it online. So I'm not sure if we're going to fill that demand really, really quickly.
Yeah.
The last one I want to add in there is single families. And that means single family homes, very location dependent. And the reason I say that is I'm seeing in our market here, the great locations, I think are going to continue to do really well. Just kind of what we've alluded to in other times, like the rates, people are seeming to be able to handle them in a lot of ways. And there is a market of people that will still want to buy in great locations. So if you see an opportunity in a single family that's getting overlooked, that's worth buying. I don't think every single family is necessarily the best buy. I do think there's a lot of overvalued marketplaces. And I would say mid to average range neighborhoods, I'm not as stoked on them. But I do think if you're in a location that's difficult to get into and there's a deal to be had, that is still a decent buy. But I'm on the fence a little bit because I do think there's going to be some downward pressure here in the next couple of years.
Well,
so those are my buys.
Okay.
That's my take on
Yeah,
buying right now.
I mean,
and I will say, amazing deals as a whole, always.
Yeah.
That's always the case. Like if someone comes to you with a multi-unit that's just like way too cheap to be good, you should be buying it. Like if residential rental
totally
makes sense,
and
it's a great deal. Like great deals always are great deals.
And I think there could be some great deals coming up in this environment in the next year or so.
Yeah.
So I guess I'll be more general with my commentary because I like what you said there. I would say buy what you know. We talked about this on a previous episode. I would be buying what I really understand and really know. I don't think this is a great time to change lanes, to try to get cute, to try to get exploratory. I think it's a good time to be a bit conservative, and one of the more conservative things you can do is just do what you do well. Continue to do that. So I would buy based on what you have a high level of experience and comfort with. The other thing I would look at strongly is buy based on cash. And what I mean by that is buy plays that you'll have a really good cash position either on the purchase itself, like where you have high equity from day one because you're able to put a lot of cash down, or a situation where the cash on cash return is immediately good from day one, or there is a cash coming back to you in some form. And I mean at a high level of comfort on a end value refi position, right? I think you just need to feel really good about your cash positioning in the property month to month and in a finite timeline at the end. I think that's huge right now because cash and liquidity are going to be big, not only for taking advantage of these opportunities that we do think are coming, but also just to protect yourself to weather the storm until those opportunities come around and until you can get positive on all these things. So that would be my buying take. What about
okay? You want to go straight to hold?
Let's go sell.
Or sell?
Let's go sell.
Okay, let's go sell. Okay, well, I'll start then on the selling side, and I'm gonna focus on single families to begin with because I'm in this weird back and forth in my head where I think, again, on the buy side, single families make sense.
But on the sell side, it makes sense too. Classic realtor. Great time to sell, great time to buy. What a realtor.
You should basically always be doing transactions with us. No, but so no, seriously, like I want to really hone in on that. So buying single families, it's nuanced. Like it's got to be great locations.
Yeah.
I'm seeing, again, for the Halifax market, I'm seeing like houses now in North End. There's multiple homes now over $2 million. And I do suspect that neighborhood's going to get to that place where you see a ton of rehabbed homes that are 7 figures.
Yeah.
And so like, there's opportunities to buy there. I don't think that those will get any better. Like I see houses, little houses popping up around $500,000. And I'm like, you may never get to get in here again because the second one of these $2 million houses sells, that piece of land that it sits on is immediately worth $500,000 to $800,000. So you're now getting in for less than that.
Not to put you on the hot seat, but you and I are working on a lot land deal in, honestly, easily one of the best locations in the city. And it's a phenomenal opportunity for your buyers to execute on. I know we can't talk about that too much on air, but that's the sort of location that, oh my God, you know, it's there's a really big swing right now in the city because there's so many things trading for north of $1 million now, and yet there's still this availability of homes and opportunities between 650 and 850, which tend to be the most hardest hit section of the market here locally. And I'm looking at like, oh my God, you could take these $650,000 to $800,000 homes, and you could spend $350 on them, and honestly, you've got a $1.5 million home there. Like that, because routinely homes are selling for $1.5 million. And in fact, there's even a shortage of homes at $1.5 million. There's a bunch that are kind of like around 1.1, 1.2. You're like, yeah, that's okay. And there's a bunch of $2 million. Like if you had a phenomenal home right now in the right location of Halifax for $1.5 million, people would gobble it up. Anyway, we're getting sidetracked here. What are you selling? Let's focus on
back to selling. So on focusing on the single family side first, I think you need to be able to look at your market and be like, okay, am I in an overinflated marketplace that did really well because the market was exploding? And to me, those are, I think, kind of suburban sprawl neighborhoods that sit on the outskirts of whatever city you're in. I think a lot of those neighborhoods were trading at super high valuations, and they came up really, really fast. Like people were buying them, let's say a brand new build for $600,000-$700,000, then they're worth 1.2. Those marketplaces, for 2 reasons to me. First of all, location isn't necessarily amazing. It's good, and like they're not bad neighborhoods. But when you look at the differential between kind of what they're up against, I think there's an opportunity maybe to downsize or move closer into town. I think, again, being closer is important. So I think those neighborhoods are slightly overvalued because of that, or slightly inflated because of that during like the COVID times. Additionally, I think they're inflated because those neighborhoods I find are usually 2 working individuals buying a home. Mm-hmm. And so you would look at it where 2 people with decent jobs were getting qualified at super low rates, which allowed those prices to get super inflated. Now, the same buyer that's going to buy that house is that same person. It's likely going to be 2 employed individuals. They're not going to get qualified. They're just not. The rate's up 400 points. They're going to get qualified for a lot less. And so I think it's going to put downward pressure on a lot of those neighborhoods. So on the single family side, I think if you're considering, like, hey, I want to move into town or I want to change where I'm at, I think those kind of overinflated neighborhoods, the ones that saw these massive gains, I think are something to consider potentially if you have the option of getting out of. And I might be wrong. Like those might continue to run, but to me, I just can't see it when there's options throughout town, and as there's downward pressure across the board, there's going to be deals popping up in places that are going to suck the buyers out from the outskirts, and they're going to bring them inwards because there's going to be deals within the inner core. So that's my residential one. The second portion of that is secondary properties. If you're not really using your secondary property or potentially Airbnb-ing it, I think there might be an opportunity to get out while the market for those is still very hot. Not very hot, but I'd still say decently hot. they went ballistic. Everybody was buying secondary properties because they're getting cash out of their homes and money was cheap. So they did very, very well. But now there's going to be a drop off on that. That's going to be one of the first ones to drop off. And so to me, it's like I would make a shift on that quickly if I'm going to do it or try it. Additionally, I've been chatting with people who Airbnb a lot of their secondary properties, and they said booking volume is way down,
Interesting.
like 50% down.
Really?
And so I think that's kind of an indication of people just don't have as much cash to be spending, right? Like, and the market was just all roses. So everybody.
Well,
was just doing everything.
we're comparing it to recent years where it's like, well, there's COVID, so you can't go down south, and everyone has a lot of money. So like, it was a perfect storm for the short-term rental game. Like, it was a perfect scenario if you had a short-term rental over the last couple of years. Yeah.
Yeah. So that might change as time goes on here, but to me, I don't know that it is. I think, like you said, it's no longer COVID. There's no rules when you're in town, and there's opportunities to travel other places in the world. But I think as a whole, the travel industry is going to slow. Right? People are looking for cheaper alternatives. Cruises are doing really well because they're a much cheaper alternative, right? And so that same mindset, I think, if you have a secondary property that you're like on the fence about, this might be an opportunity to get out of it while you can still make some money, because I think that market's going to slow heavily in the next couple of years.
I'll speak, from the selling perspective. I think if I were to take a contrarian point of view to that, it would be if there are leaner times ahead and you have a good position in your primary residence, i.e., you've got a low rate that's fixed in, you've got some captured appreciation there. It might be just a chance to like be thankful for the position you're in and just enjoy that and take a pause. So I'd be wary of
100%.
selling something that's in a good position, even if it's like trying to be opportunistic or worried that, oh my gosh, maybe I'm at the peak now. I might give back, $50,000 over the next 18 months. It's like, sure, but if the alternative is you change your living position and it's less advantageous, it might not make sense.
I'm saying this more from an investment perspective.
Yeah.
I don't mean at all to be taking your personal home and selling it and then renting for a year in the assumption that you're going to get back in at a cheaper price point.
Yeah.
I think that's just a bad game to play. It's the same thing when you're investing in stocks. Don't try and time the tops and the bottoms. Like, it's the same thing with housing. I don't think that's the play, but I do think if you're an investor or you have multiple properties, or you're already like 90% of the way to being like, I kind of want out of this neighborhood, or I kind of want to live somewhere else, or whatever it may be. I think there's a potential for an option to make the switch.
Yeah.
And what you said with losing the gains, that's 100% right. Like, people need to change that mindset, because your house was only worth 600 last year, 2 years ago, and now it's worth 900. So to go back to 800 or 850, really none of it was realized, right? So it's like, it's still way ahead of where it was before. So don't be upset by that, I don't think.
Yeah. In terms of what to sell, like, I know that, I'm preparing a property for sale currently, and I've got a few clients who are looking at their overall portfolio. Like, well, gosh, and I have this situation, like, I've got 12 units, I've got 15 units, I've got 6s, I've got 8s, I've got an 18, like, I've got stuff, but then I also have the duplex, the house, the this little thing, that little thing, and it is sort of looking at, well, those properties have a fair bit of maintenance, they take, time and attention, and they're not really serving the overall portfolio well at all right now. In fact, a lot of cases, if they're on variable, they're underwater. And if they're in good locations, and if they still satisfy potentially like an owner-occupied situation where an owner-occupied buyer is still willing to pay top of the market, maybe those are an opportunistic sale as well, because you can't flip these small multi-unit products to investors right now because the numbers don't make sense, right? Like, you can't sell a duplex. It's even hard to sell a triplex to an investor right now because chances are the numbers don't make sense, right? It's hard.
Owner-occupied.
Yeah. But owner-occupied, they start to make sense again. So if you have something like that is sort of dragging your portfolio down a little bit, it's a good time to sell because the demand for that, the pricing for that is still really good. And you can kind of capture that while at the same time improving the overall performance of your portfolio. So take, for an example, something in your portfolio that right now might be losing $800 a month, right? If you could sell that, like, what would you have to do to go out and add $800 a month to your portfolio? you would have to probably go out and buy something like a well-performing 6-unit building where you profit $150 a unit per month. Like, it'd be hard to go out there and replicate $800 of net profit on a property purchase right now. So if you take a property that's losing you $800 a month and can just take that off your books while at the same time potentially bringing in a couple $100,000 of liquidity, captured equity from the sale of that property, that may not be a bad option right now. And if the market was softer and you couldn't get full value for that property, I'd probably try to ride it out. If it is currently, doing well and making money, I'd also think it's worthwhile riding that out. But if you have something, and I know a lot of investors out there do, it might be a good time to part with those smaller things that were good at the time but aren't where you're at now. I've got another client. I mean, he's got everything from single family homes to 30-unit, but it's a mixed bag. And he's looking at his overall positioning and said, well, gosh, I could sell something over here, take $300,000 and be rid of a property that's maybe breaking even. So it's not bad. It's breaking even, but it frees up $300,000. One, there's a lot of great things I can do with that $300,000, but I can also just shift it right over to another property I have and profit, probably return, like, what would the interest savings be on $300,000 right now? $1,800 a month, right?
Yeah.
So you get rid of a liability, which is the debt, and you increase your profit by $1,800 a month. Like, that's not too bad, right?
No.
You're taking on less liability. You're bringing in more money. Isn't that kind of what this is all about? So again, you can only do that with certain properties. It has to be stuff that still appeals to, I think, the owner-occupied, buyer sentiment market. And it only makes sense to do it if it's an underperforming asset, or you can take that equity and move it to make another property better performing. And this kind of transitions us over into the whole department.
No, not yet. I want to go back to that for a sec. So to your point, I think the mindset I think that's worth considering is capital appreciation. I think capital appreciation is going to be reduced, right? Like, I think we can all agree that if you're expecting a ton of price lift, it might not be worth holding on to it. And so, to what you're saying,
because you're thinking you're not going to see that as much in the future.
No, and it doesn't make sense that you would for the next little while. I think capital appreciation is being reduced. So if you own property that you only make money on capital appreciation, it's not making those monthlies, it might be a worthwhile consideration to flip it off. Another big segment that we're not thinking about because we don't see it as much locally to us, but it's condos, right? Like, we've talked about how 80% of condos in Toronto, the owners, investment condos in Toronto, run into negative. And basically they're all okay doing that because they're expecting some sort of capital appreciation.
Yeah.
But now, when you have interest rate pressure and there's actual inventory on the market, you're not going to see that, right? So it might be prudent, if you can, to make a shift in advance, take out your cash, like you're saying, remove that negative balance on a monthly basis and get rid of that interest cost, and then allocate that money to go somewhere else, or to prep yourself towards buying a better deal in the years to come.
Yeah.
Right. And so I think that's my last thing on the residential side. I think condos are something that is heavily predicated on capital appreciation, and basically the biggest fighter of that is interest rates. And we are in a high interest rate market relative to where we were, with very high debt ratios. So last thing on residential, I would definitely consider selling condos if it's not something that's like you'll never get again, or something that you really, really need in your life. On the commercial side, for selling, I mean, everyone's office is everyone's screaming it, sell your office, sell your office. It's hard to say. I mean, if you can float it, I mean, that's great. But I think a lot of people are selling their office because there's not an option to float it, and making residential conversions is super, super expensive. So I think we'll see it here as a good portion of commercial debt matures in the next 2 years in Canada and the US. You'll see a lot of office space come up. Additionally, retail to me seems concerning. Just when you think if the economy has slowed, people are going to spend less money. There's going to be a lot of stores, if they're small, that might go out of business or reduce their footprint. And there's like the online shift that really did take over. I think that's going to continue, especially now as you see there's more tech going towards online shopping, like this AR headset from Apple. Like, those are going to change the market and continue to put pressure towards online shopping and less in-person shopping. So to me, retail, unless it's anchored by certain types of stores, it doesn't make a ton of sense. Even groceries now, like most of the largest grocery chains, are putting in a ton of work into automating and just shipping all your groceries to your house, right? And I think that's going to start to make more and more sense. So to me, selling residential property that is not in a great location, potentially overinflated, or you're banking on capital appreciation is a good time. Like Chandler mentioned, if it's not making money for you on a monthly basis and doesn't really have a greater play, there might be an option to get it sold out and someone else who's owner occupied and can get their hands dirty in that property. It makes a lot more sense. Don't be afraid to be like, well, I'm going to sell it for 500 and it's going to be worth 7 once I get in there and do all this stuff. And you're like, yeah, well, there's always going to be someone that's going to make a bit of money off it. Like, you need to look at where you're at and see if it aligns with your goals. But anyways, moving into the hold market.
Mm-hmm.
And this is kind of funny. On every single line, I have single families with a question
Oh
mark.
my god!
And it's a question mark asterisk.
This
Because it's
guy.
like,
Well, I touched on that a little bit because I think the whole mentality with the single family stuff is, my gosh, don't rock the boat. Like, if you think you're potentially compromised, don't rock the boat. Right? Ride it out.
And if you love a neighborhood and like there's a bunch of asterisks to that that's like it's very specific. And exactly, ride it out. Things go up and down at the end of the day. If you're in a comfortable position, you can float your mortgage, and you don't see yourself being able to get back into that neighborhood. Additionally, really good neighborhoods are really not going to get that negatively impacted.
No.
Like, there's a lot of people who are putting a lot of big down payments in good neighborhoods, and that'll just hold on to it because they know it's a good neighborhood. So just consider that if you're in a good location and somewhere you want to be for an extended period of time, selling right now, there might be a chance there's an opportunity, but there's also a strong chance that there may never be another good opportunity to get in. Residential rentals. So res rentals, I think, are worth holding on to right now, assuming that you're able to get them in a decent mortgage setup where you can cash flow and you can kind of keep making your annual increases. Also, projecting out the upcoming maintenance. Right, so you need to take a building and be like, okay, let me look at this next 20 years. These are in 10 years I have a roof. In 6 years I have a furnace. Go through all those and actually make sense and bring it all back and see, okay, hold up, am I actually going to make any money once I pay for all of those things? And assume limited capital appreciation. And the reason I say that is not just because interest rates, it's because rent caps across the board in Canada. At the end of the day, once the rent caps go in, residential rentals, the only other time you're going to see actual capital appreciation is if the land underneath it is zoned or allows you to build something way more. Otherwise, when you're looking at a 10-unit building, if it's sitting on a lot that probably got downzoned, like there's a lot of that where you see buildings that got built in areas that ultimately got downzoned, and it's only ever going to be a 10-unit. If it gets torn down, it's going to turn into a fourplex. You got to project all of your numbers and see that it actually makes sense and assume rates that are probably similar to now. Maybe a little bit less, but assume an average rate of maybe 4 or 5%, and run your numbers. And if that works well and you see nice income coming from that and an opportunity to get a little bit of appreciation over time that you force through the rent increases, I think those are worth holding on to. Back to what Chandler said, if you're not making money or there isn't really a play there, it might be worth looking at offloading that and giving it to someone who's more interested in getting their hands dirty or is making an investment for an alternative reason. Maybe they own property around it or they see something that you don't. I think that one's good. And then warehousing. I'm going to mention on the commercial side, I think warehousing is a worthwhile hold. The industrial industries in Canada are doing very well, and I think they're going to continue to do very well with the amount of construction taking place and that the amount that's still going to come. Yes, we're talking about slowdowns in certain cities, and so I don't maybe not buy warehousing in overinflated markets. That's the same concept, but as a whole, I think the warehousing market will do well simply where everything goes online. It's the same idea as storage. There's a lot of new businesses that are constantly evolving that need that space, and I think just when you see population growth, with that comes a requirement for space to run businesses and to store stuff. And so I think warehousing is a good place. And I think a lot of the people that go out of the retail spaces, like a lot of their businesses are actually taking on more warehousing space at the same time, right? So I think those are kind of my whole things.
Yeah, I'll just focus on the multi-unit stuff because by contrast to the small scale underperforming things that appeal to, owner occupied situations, I think it's an opportunistic time to look at selling those. I think the true purpose built multi-unit commercial, i.e. 6 units and above, that's the stuff that you want to hold onto. Those are the anchors of a portfolio, assuming you've done a halfway decent job of getting them run properly. Those are the core assets, right? If you're looking at what you're aiming to do, what you're trying to do, building your little piece of the pie, isn't that kind of what we all want? It is true purpose-built multi-units because your exposure is actually far less than the small, janky 1 and 2 units and 3 units. Purpose-built larger things are so much easier to manage. They're so much easier to get meaningful rent increases because you've got more units. So even a small percent, when you multiply it across, say, 10 units, it's much more impactful. I think those are obviously the things that you want to hold on to.
Yep. Agreed. I think in the summarize I talked about before, but like capital appreciation might be limited. So if your property is banking on that, then that's something I think worth considering, maybe making a change. Or if there isn't a long-term play out of the land, it's something that you should really consider. And it might serve someone else better who's just trying to get into the market and is willing to make the stepping stones. Like, when you start, you shouldn't be afraid to get into some uglier properties or not ideal properties, because sometimes they serve a purpose to allow you to make a step forward. But as you've built a base and you continue to invest, it becomes a lot more important that you're prudent with what you're buying, because it needs to meet what your end goal is or whatever you want to be running with your portfolio.
Yeah, absolutely.
So also, I'm going to say the reason I didn't say buy warehousing is because I think it's been on a run for a while, and I don't know how much further
and you won't be able to find it anyway, so it's a moot point. Yeah.
Locally you're not going to be able to find it. Even I've heard Ontario is pretty much the same, but as a whole, I don't know how much further it has to go. The other thing, in general, is green space and land. I forgot to add that to buying. I put development land, but if you have a ton of cash and you want to buy agricultural land, I think that's a smart play for a bunch of reasons. We obviously have a ton of food insecurity and issues there, but I also think that there's going to be a lot of value that goes into agricultural land around the carbon credit space. And so
I just think that's a
whole nother topic.
That's a long hold. And a lot of risk exposure, because there wouldn't be a lot of revenue on that, at least in the short term.
Well, if you have cash, if you have a lot of cash, and I think that's what you're seeing, like the richest in the world, that's what they're buying, a ton of land. People, once they start having a ton of cash around, they buy a ton of land. I think it's an aspect of like, where can you put your cash? They make a very low return on it on a cash flow basis, but they're paying cash for the land. But I think you're banking on some high potential appreciation, because I think food prices will continue to increase. I also think carbon credit values are going to increase a lot, which there is going to be some major offsets from farmland that I think will ultimately result in farmland having a massive run up. Probably, I don't know how soon, it could be 2025, but I think it'll probably be 2030. But again, that's for a whole different market. So
cool.
Buy good properties, effectively. Buy amazing deals and well-located properties. I think there will be blood in the water in the next couple of years, so keep an eye out for those. Hold on to your properties that are in good locations, have good baseline numbers, and are in demand right now. I think selling properties that potentially were really, really hot in the last couple of years, maybe got a bit overinflated, like secondary properties outside of town, if they're not on coveted lakes or whatever it may be, that's a great time to get rid of them. Houses within the city that are in areas that exploded during COVID, but maybe still have some of the issues that they had prior to their build outs. Office space, if you have it, retail, if you have it, I think it's not a good time to offload it, but it might be potentially, I don't think it's going to get any better for a couple of years. So if you need to get rid of it, or if it's dragging you down, get rid of it.
If it's improving your overall portfolio, if it's addition by subtraction kind of deal.
Yeah. And if you're buying storage, I mean, I'd be curious to see how it goes. I'm super interested to see if storage ends up being what everyone expected, just again, because it seems like the thing from 2008. So everybody's doing it right now, but maybe that's just how I feel with my social media following.
Yeah, I know, 100%.
Sure some of you guys follow Investor Go Brit, and she's storage.
Interesting. Cool. All right. Well, thanks so much for listening. As always, guys, if you found something of value here, please share it, repost it, comment below. Thanks. Thanks so much for watching the episode. I hope you enjoyed it. If you did, press like. Don't forget to subscribe. But also check us out on Instagram and TikTok. You can find all the links below. Thanks again for checking us out.
Broke, I had rich habits. When I was broke, I had rich habits.